Hey, this is Hector Villafan. You guys know me as Homeboy Hector on TikTok and Instagram. And I've been a real estate agent here in the Central Valley since 2016. And this is going to be a home buyer course video. But before I get into the video, I do want to talk a little bit about myself, let you guys know who I am, a little bit of background on me. So I am born and raised here in the Central Valley. I was born in Modesto, went on to Series High, went on to MJC, went to Stanislaus State, got my degree back in 2005 in Computer Information Systems, CIS. Went on to work at EJ Gallo Wine Company in IT in a data center. I never knew what a data center was until I got to work at a data center. And now you might hear about data centers a lot more nowadays because they're pretty much what's used to power these technology companies or companies in general, like AI, for example. I'm using AI in this video that I'm making for you guys using the website Loom. So after I'm done with the video, it should provide a transcript for me of the video. That way you guys have something you can follow. So at the data center, working for E&J Gallo Wine Company, I got to learn some pretty cool stuff in regards to IT and how things work. And I thought, hey, why not take a gamble on myself, quit my job, my very secure, good paying job, working in the IT department for EJ Gallo Wine Company, and take a risk on myself and get into real estate. And that's what I did. So I graduated from college in 2005. I worked for Gallo starting in 2006 to 2016. I worked there for 10 years, then I quit. And the first brokerage I went to was PMZ Real Estate. Now, here's the thing is I was brand new to the business. And I thought, why not go with the broker that seems like they have the most listings and the most sales in the area? And at that moment, at that time, and still to this day, the number one, I guess, real estate team in regards to retail sales, the Real Group, they're based out of there. So I'm like, hey, let me go work for the number one company and learn from the number one group. But once I got there, I realized that it's not that easy. You can't just go, hey, can I go learn from you? So they put me out in Oakdale, at the Oakdale office, and they were all real good realtors. But I realized real quick that they all had a particular ceiling. They knew retail real estate, and that was about it. And I wanted to learn how to invest. I did not quit my day job at Gallo to just go make another job for myself. My goal was to learn about real estate, start as a realtor, and then move on up, learn how to invest. So right there, when I was at PMZ, there was no one to learn investing from. Everybody was like, "Hey, Hector, just go sell homes. Don't worry about investing right now. You can't do it. You don't have enough money. You're brand new." All these things, all the reasons I supposedly couldn't do it. And then from PMZ, I left PMZ after, I don't know, about maybe 9 months or so. I sold my first few homes for them. Then I went to Coldwell Banker, and the broker for Coldwell Banker at the time, or he's still the broker, but no longer Coldwell Banker. They changed company names. But he was a broker who also did investing. That's how he made his money. And during the recession in 2003, 2004, 2005, no joke, they were flipping 100 homes a year. Not selling, but flipping 100 homes a year. He was a contractor, he was a broker, he was all this and that. So I went to his company, I went over to that brokerage, and that's where my real estate career really took off. I was able to utilize my skills in IT and marketing and generate leads and generate sales to the point where I was selling 50 homes a year and doing pretty good. But the thing with real estate is when you're selling 50 homes a year, you're not going to have much of a life. Like you're going to be working a whole bunch, showing a lot of homes. And that's kind of what happened. And I was in, just starting my family. I had 3 kids, And my third child, or my wife, our third baby, my son, he had a heart disease. And he's had 3 heart surgeries since he's been born. And I kind of started scaling back on the retail as far as working with buyers and sellers and stuff like that. And then use that downtime to be at home, be present with my wife and kids and learn more about investing and get more into the investing side. So that's how I went from retail to wholesale to fixed flip, learning about Airbnbs and learning about all these different things. Now, in this home buyer course video, I'm going to keep it just to buying a regular either 1 to 4 units using the most common loans, which is the FHA and the conventional type loans that first time buyers tend to work with. Now, in this home buyer course, I also went ahead. So I got a few domains. So the domain that you're going to be on right now is homebuyercourse.online. Now, I don't go into all the details. Um, I do give you a basic overview so that you're able to understand it and enough where you're going to get some value for sure. Now, if you choose to want to learn more, I do have these other 2 domains that will be live sooner, hopefully rather than later. And once they are, I'll announce that to everyone. But I'm going to get into really, really detailed videos and descriptions. One course will be in English, one course will be in Spanish, and they're going to be completely free. I'm not looking to make any money off of this, but here's what I do ask. If you sit through it and go through these videos, you're going to get a whole lot of value. What I ask is that either if yourself or someone you know is interested in real estate, please refer them to me. Originally, if you look at my social media, now this is not my original real estate social media page here. Originally, I was on Instagram. Originally, actually, I was on Facebook. I had a Facebook business page that really took off. And in 2019, I was ranked the #1 realtor on social media by a website called Property Spark. As of last year, that website is no longer active. So I can't go verify and show you guys. But anyways, I had so much social media that it got overwhelming and I ended up deleting a lot of those accounts when I was phasing myself out of retail and going into the investing side. When I switched over to the investing side, I had this gentleman here, Mr. Jorge Contreras. He is a Airbnb guru, and I paid $7,500 to be a lifetime member of his inner circle. So we have weekly Zooms, and then our Facebook group, we can have our private group, we can ask questions regarding Airbnb. So this is one of my coaches that I paid for and hired to help me learn about the business. And in that home buyer course video or that other website that I'm making, I'll go into lots of detail on Airbnb. Like you're gonna get the lowdown. You're not gonna have to pay no $7,500. It's gonna be free. This is my other coach, Mike Barron. I paid $50,000 to be a part of his program, and he's the one that told me, he's like, Hector, if you do a program where you teach people all the knowledge that you know and you charge them, you'll make more money than you ever did trying to sell homes. So if when I first came to TikTok, you'll see it here. I start the page as a realtor. I'm like brand new to TikTok, brand new to talking in front of the camera. I did not like it. And then when you see these videos here, this is when I start to, okay, let me practice trying to get this real estate course off the ground. And I was doing a series of like 1-minute videos, step this, step that. So you can go back and watch this. But to be honest with you guys, I don't like making those type of videos for social media. I'm in my 40s. I don't got time really for the shit, to be honest. Right? So I tried it and I'm like, dude, I don't got time for this. Like I've got to be out fucking hustling and selling homes. I can't be wasting my time with this bullshit. So believe it or not, just this little series of videos here that you see on buying a home took me so much time that it was just too much. My focus needs to be on selling homes. And then I came up with a name for my school. It was going to be the B&B Hub, where we talk everything about Airbnbs and other real estate. Um, then around this time here, my son's here's my son right here. A little bit after that, he had his last surgery. I took some time off and I hired a virtual assistant in the Philippines to make these other videos for me, where it's like different kind of Airbnb tips. So this is where she gets involved. She's really awesome at what she does, and she makes those videos for me. And then I take time off. I literally stopped making videos pretty much for like 2 years. Um, I got off of TikTok, didn't do much on there. And then just recently, this week, my cousin here, who's in my latest TikTok, he's like, "Hey man, how about getting back into real estate and let's help some buyers get into homes?" You know, and I thought, why not? Let's give it a shot. So I started it with these latest TikTok videos that most of you saw, and had reached out to me and left some likes, comments, and all that good stuff. And I want to thank you guys for that. I have some bad experiences working with buyers, 2, 3 years ago, that also made me not want to work with retail real estate anymore. But since then, there's been a huge change in real estate. It's actually the biggest change in real estate as far as retail ever in the history of real estate, and that happened last year. So let me talk about what happened. So last year, there was a new law. Now I'm going to get into the home buying process. Here's where it starts. Um, Whenever a home goes for sale, so let's say there's a home for sale for $400,000. That's going to be our example here, just to keep the numbers easy. And $400,000 is a number that is very common, average number for home values here in the Central Valley. So let's say Mr. Home Seller wants to sell his home and contacts an agent. The agent will then charge a fee to sell that home, and that percentage is going to be between 4% to 6%. Why is it 4 to 6%? That's just the way it was since this started back with the National Association of Realtors. That's what was considered a average fair fee, and brokerages enforce that. Now, I mentioned that I got started with PMZ Real Estate back in 2016. If I went to a listing appointment and I tried coming back to my office with the listing at 4%, I would get written up, or I'd have to maybe go take a manager with me and try to get that at 5%. They would not accept it. And this is with PMZ Real Estate here in Modesto. And what I didn't agree with and I didn't like is like, well, if I'm willing to do it for 4%, you're not doing anything to help me sell this home, PMZ. I'm going to be doing all the work. Why should it matter to you? Realtors make the brokerages the money. Brokerages don't make realtors money. The way real estate brokerages are today and the way technology has advanced, we don't need brokerages to sell homes, agents. We use TikTok, we use marketing, we use all these tools. And frankly, I'm ahead of the game when it comes to anybody in my office, really. So brokerages were forcing me to charge that percentage. The lawsuit and the reason the law changed was homeowners were like, hey, why does it have to be 4 to 6%? And why does part of that fee, why do I have to pay the buyer's agent commission? So when a home goes for sale, goes on the market, in this $400,000 example, let's say 5%. Let's say we meet in the middle. Well, 5% of 400,000, that's $20,000. So homeowners can have to pay $20,000 to sell that home. Now, this fee is to be split 50-50 between the agent that puts the home up for sale, and then there's going to be another agent that brings a buyer. And you have two separate contracts now. You have one contract or two separate sides of the contract of the deal. You have the seller side and you have the buyer side. Okay, and the buyer is supposed to negotiate the best possible as best possible as they can for their buyer. Listing agent's supposed to do that for their seller. So it's going to be $10,000 for the listing side and $10,000 for the buyer side. Now, what happens if the agent lists the home and then someone sees the advertisement online and calls that listing agent directly and they have no buyer's agent? Well, now the listing agent makes $20,000. They're going to make that full 5%. So the way the law has changed is before sellers were forced to pay that buyer's commission. Now that buyer's commission is optional. It's optional. What does that mean? Now, when the law changed in August of 2024, we thought there was going to be a big change in real estate. It turns out there has not. As of now, the sellers are still offering to pay a buyer's agent commission. The only difference now is that it's not clearly stated in the MLS. The MLS is where agents, we upload properties to look at the values, to look at the private details. And in the past, with the commission that was being offered was listed and visible and known to us. Now it's just private. Why is that? In some cases, some sellers offer more commission than others. Some sellers might offer 0 to no commission. What the law wanted is for agents to show properties regardless of how much commission they're being offered, so that there's no steering you towards a property where maybe I might make more. Let's say you like 2 homes and they're identical, and one is offering me 0 commission and one is offering me $20,000 commission. I am to show you those properties equally and not try to steer you from one to the other. So that's part of the new law, right? I've never done anything shady like that, so you don't have to worry about that. Now, here's the other thing. Before, to go view a home, you did not need anything in writing. It was optional. Now, to go show a buyer homes, we need something in writing. Now, I'm going to get into what kind of turned me off of retail real estate and a little bit of what got me back into it. So let's say I had a client and I've spent a month showing them homes, and I've showed them 15 homes. And I've gone from San Joaquin County to Stanislaus County to Merced County. And when I first met these buyers, they were coming from the Bay Area. They had very limited funds. And I told them, hey, we should just go to Merced. But no, they wanted to start in Stockton because Stockton was closer. I said, I'm not going to steer them somewhere. I'm going to be honest and do my job and have some integrity and go show them what they want to see. So I show them 5 in Stockton, 5 in Stockton. I show them like another 7 homes in Stanislaus, and then they go to Merced on their own because they're supposedly frustrated with me. They go to Merced, they go to an open house. The home is brand new, and they're able to. And then when they go to the open house, the listing agent says, "Hey, if you sign this right now, I can get you into this home." So what do? They signed that contract, and I just lost my client. And an agent who was hosting an open house who met him for the first time, now they're going to get paid. So my thing was, I would tell my clients, hey, don't go, if you see any homes without me, don't sign anything and this and that. And they just weren't honoring it. So I like the new law. I like the fact that sellers now have more of a right to negotiate. I like the fact that tactics that created steering, some of those things have been removed. And I like the fact that now we have to have a written agreement with our buyers before we go to show them homes. Now, here's what happened with me. If you go to my Zillow and see, I've sold over 155 homes on the retail side. I took a big break. And in 2024, these 3 homes were just referrals from friends. And then in 2025, this year, I helped a family that I had such a great time helping them that it kind of got me back into the game. So if you see here, I live in Modesto, in Stanislaus, Burbank, but I grew up in Modesto. I sold a home in Hollister, which is pretty far away. This family was referred to me by a family that I helped relocate from Monterey. They they were renters in Monterey, and I helped them buy a home in Los Banos. So that family referred them to me, and they're like, "Hey, we want to buy a home in Monterey, in the Monterey area, but we can't find an agent to help us because we need down payment assistance and this and that, and we're kind of getting ignored." So I told them, "It's like, hey, I'll work with you guys, but we're far away. If you're willing to view some homes on your own when possible, since I'm far away, and I only go look at the ones that you really like and that you want to put an offer on, we can make this work." I won't be able to physically join you for every one of these viewings, but I've sold so many homes and I work in real estate that I really don't need to. It just matters to let me know which one you like, then I'll go look at that one, and I'll work diligently on finding out as much as I can about that property to make sure it makes sense for you. So that's the way we did it. They probably looked like I had 10 homes on their own. I only went to Hollister 3 times. When I met them, and then to show them the home they really liked and go into detail on that, and then to give them the keys. That was it. And I'm like, man, like they were so honest and such great people to work with. They didn't just throw me out to the curb, and they worked with my situation. But I was able to get them into a home in Monterey with down payment assistance, help with closing costs, and help with the buyer's rate. Like I was able to do that from Modesto with somebody out in Hollister. So to all the people that are watching this video and you're in my backyard, if you work with me, I'm gonna fucking kill it for you. Um, but that's how the law has changed. So don't worry, you don't have to pay a buyer's agent fee. Sellers are still paying for that. If for some reason buyers had to pay their own commissions right now, the market would be even worse because that just creates another barrier to entry. Okay, so let's go on to um, more of the home buying process. So before you can buy a home, you have to have sufficient credit. So when it comes to credit, it's recommended that you have 3 lines of credit is often best, no more when it comes to revolving debt. So credit cards, department store cards, Visas, MasterCards, Target card, whatever it is. Now, installment loans like uh, car payments, car loans, stuff like that, those are actually good debt. And you don't always want to necessarily pay those off when you're going to go buy a home, because if you do, it can actually lower your credit. Paying off your credit cards will help more than paying off a car. And your credit cards, you want to make sure that you're paying those off as soon as you can, and you're not going over 50% on either of those credit cards. So one of the things I did when I first got my credit cards, I used one the most. And if for some reason that one got full, I would use my other cards that I had. That was the wrong approach. I should have used that card up to 50% and no more. And once I got to 50%, go use another card. Okay, if possible. So that's just some credit tips for you guys. Now, when it comes to applying for these loans, it can be your income. It's fine. You can be self-employed or have an employer, W-2. You can still qualify for this loan. The next thing that creditors are going to look at is your debt to income ratio. So what is that? Let's do a quick little Google search for debt to income ratio. And let's see what AI tells us. So it's a metric that lenders use to measure how much of your gross monthly income is allocated to monthly debt payments. It is calculated by dividing your monthly debt payments by your gross monthly income. A lower DTI is generally considered better, with many lenders preferring a ratio of 36% or lower to consider you qualified for a borrow, though higher ratios are sometimes approved based on factors like credit history. So the DTI typically, we don't want it going over 40%. Okay, and this is something that you could, in essence, calculate on your own. So these are the things that will determine how much you can borrow, at what rate, or whatnot. Next, we're going to go on to the loan types. Before I go into loan types, let me get into interest rates really quick. So I want you to use this link that I've included here. And this shows you the historical interest rates for the United States on one page. So during COVID, you see that they got down to the 2-3% area. In my other home buyer course, I'm going to get super detailed into this, but I do want to touch on it before I move on further in the video and explain something very important. So what happened during COVID, you see that interest rates were down here in the 2%. And when people say that's never going to happen again, it is not. So for the people that are waiting for rates to get down in this range, all you have to do is look at this table, this graphic here, and it shows you that is not going to happen again. Historically, interest rates are closer here to like the 5, although we were low there for a long time. We were much lower. But historically, in the last 10, 15 years, we're around the 5. Before that, rates were more like near 7. You see that? So once I do the other course, I'll get super detailed into why the reasons are that this happened. But I want you to understand that these rates are not going to happen again. So if this is what you're waiting for, you're going to wait forever. And we'll move on just because there's going to be a video about 30 minutes long dedicated just to the interest rate and why it is what it is. Now, let's talk loan programs. Okay, what are these actual loans that can help me get into a home? So in the previous example up there, I mentioned a purchase price in the example of $400,000 for a home. $400,000. So let me change something real quick. Let's change this to 400. And let's change this to 350. And this is 3.5% down. Okay. So let's say you gather up your loan requirements to submit an application. So you're going to need 2 years of taxes with your W-2s. You're going to need 2 months of bank statements, all pages. You're going to need your 1 month of pay stubs, your social security number, and then they're going to run your credit. Now, let's say you go and you get approved for $400,000 and for a regular FHA loan with no down payment assistance, and you get approved for 3.5% down payment, or you get approved and you have to put down your 3.5%. So 3.5% of 400,000 is going to be 14,000. So that's for the down payment. Next, you are going to have to pay 2% to the lender for closing costs. So that's going to equal another $8,000. And now you're at a total of $22,000 total. Next, you're going to have to pay title fees. What are title fees? So the title fees vary by county and can vary by city. Typically in Stanislaus County, the title fees are split 50-50 between buyer and seller. Those are the fees that get paid to a local title company, which is a third neutral party. They're a neutral party. They handle all our paperwork to make sure that everything's on the up and up, that we're not missing anything. They make sure the home doesn't have any liens, title is free and clear, all that good stuff. So typically for a $400,000 purchase price, if we're going 50-50, you can expect to pay about $3,000. Okay. And that's your half. So that brings the total to $25,000. That is the total for your down payment, your closing costs, and title fees. Okay, Hector, that's not the $5,000 that you mentioned. How the heck can I get a home with only $5,000? The next option would be the CalHFA loan. Now, the CalHFA loan is going to help you cover part of the down payment. it's going to be another smaller loan on top of the home for the loan for the mortgage. So you're going to have the loan for the mortgage, which is going to be 96.5%, which is the difference of the 3.5. So it's going to be one loan at 96.5% and another loan like at 2-3%. That's going to cover most of your down payment. Now, here's the other thing though. Since the bank is going to lend you more money, they're going to say, okay, buyer, if you're able to pay your own down payment, we'll give you up to 400,000. But if you cannot, then we can only lend you 350. Now, this is just an example, right, on the numbers. So don't hold me to these numbers. These are just examples. So let's say instead of coming in with 14,000 down payment, now you only need to come in with $12,000 down payment. $2,000 down payment, because now the bank is willing to cover 12,000. So now you're only on the hook for $2,000 of the down payment, but that still leaves 8,000 in lender cost and 3,000 in title fees. Who pays for that? Here's where your agent comes in. I'm patting my chest because this is where I come in. I will negotiate with the seller and say, hey, seller, your home's been on the market for 90 days. You've got no offers. How about we offer you what you're asking, but you give us $15,000 in credit. Now, here's the thing about credits. If the lender costs are 8,000, I'm asking for 15,000. And let's say the seller agrees to it and says, yeah, I'll give you $15,000, no problem. When it comes time to close the deal and reconcile the final numbers, because what's going to happen is a title company, what they're going to do is, let's say the seller had $100,000 that he was going to walk away with in equity if he were to sell the home. Well, from that 100,000, they're going to say, oh no, hold on, Mr. Seller, 15 of those $1,000, we need to allocate those over to the buyer. So instead of getting 100,000, Mr. Seller, you're going to get 85,000 because we're going to get 15,000 to that buyer as soon as we get that written into the contract. Now, what's going to happen is once we get close to closing the deal and the bank's reconciling the final numbers, if any cost that exceeds the buyer closing cost total gets returned to the seller. So let's say, hey, Hector, we know you asked for $8,000 for your buyer. $15,000, but he only needs 8,000. So that other 7,000, we have to return it to the seller. Here's where I come in again. When I make that $15,000 request to help you buy a home, I'm going to say, I want $8,000 to help for the closing costs, and I want the other 7,000 to help buy down the buyer's rate. Help buy down the buyer's rate. What does that do? It lowers your interest rate for a certain period of time so that you save money in your pocket. So that's how we're able to get home buyers into a home with little to no money out their pocket at a lower rate. Because right now it's a buyer's market. Back during COVID, when rates were super low, when rates were during this period, if you wanted to buy a home during that period, you would need at least $50,000 in your bank account. And let me tell you why. Back then, since it was a seller's market, sellers were offering zero concessions to buyers. There was absolutely no sellers anywhere that were willing to offer any kind of help for a buyer. And not just that, let me talk about loan types real quick. An FHA loan versus a conventional loan. Let's say I want you to pretend that you're a homeowner during COVID and you want to sell your home for top dollar and you are consulting with the realtor and you're learning all these different things. And let's say your home is worth $450,000, but due to the market demand, there's a chance that you can get $500,000 for that property. There's a chance. Just because everybody was offering cash above appraisal. They were offering cash above appraisal. So let's say my home is worth 450 and I put it on the market for $450,000. And then a buyer comes and says, Hector, I'll give you $500,000. Okay, my property might not appraise for 500,000. I don't think it is. Do you have cash in your bank account, or can someone give you cash? Because this property appraises for less than 500,000 than you're offering. I want to make sure you can make up the difference in cash. So here's another thing. Are you an FHA buyer or a conventional buyer? During that time, if you had an FHA type loan, you were always second choice. You were always third choice. Number one choice was cash buyers, which were all over the place. Number two, it was conventional buyers. And the number three, it was FHA buyers. All those buyers were going to get looked at before you even got a chance. And here is why. When it comes to appraisals, when I accept an offer on my property for $500,000, the bank is going to send an appraiser to that property, and that appraiser is going to evaluate the property. If it's worth the $500,000 that we went into contract in, if it's at value or higher, this is important. If the appraisal is at value or higher, the contract just moves on. Nothing happens. But if the appraisal comes in lower, here's what that means. The bank's going to say, okay, Hector, you accepted an offer for $500,000, but your home's only worth $475,000. Therefore, we can only lend that buyer $475,000. We can't lend them $500,000. So we'll lend them $475,000. Now, me as a seller, I have an option. I can sell for $475,000, or I can cancel the deal, and the buyer gets their money back. They get their initial deposit back, which I'll talk about later in the video. They get that money back, and I don't have to sell. Or we can renegotiate terms, whether it's price, whatever, this and that. Hey, maybe I sell it to you, but let me stay in here for three months for free. Like, we can do that. So if we come to an agreement, we get that agreement in writing and we both sign off on it and the deal moves forward. But what was happening during COVID is buyers you had to offer more than what it was worth, and you have to have cash to close the deal to make up that difference should you offer more. So every market is going to have its good and its bad. Back then, the only good thing was that rates were low. But it created so much competition and the prices went up so fast that, okay, the prices skyrocketed and the rates had like a yo-yo effect. We had 15 years of steady rates under 5, pretty much, and then bam, now we're back at pre-2010 levels. The early 2000s. Now we're back at those levels. So in this current market, if you cannot get the rate that you want, we can always negotiate for you so that the seller buys down the rate for you for a certain period. You can always refinance your home later. But you have to ask yourself, am I the kind of person, or me, my family, whoever you're looking to buy a home with, are we in a position where one day we can have $50,000? Are we able to do that? Because if that's something you probably can or can't do, you want to buy now. Don't wait. If you're able to do it now, and then later on you can just refinance. Once it's time. So when it comes to rates, they're not coming down anytime soon. Now with this CalHFA loan that I mentioned, it's going to cover most of your costs. The other thing with FHA, these type of homes, is they have to be move-in ready. Things such as peeling paint, cracked windows, broken outlets, no heating. Those are things that will disqualify a home from a CalHFA, an FHA loan. The home has to be in tip-top condition. Now, when it comes to a conventional loan, the home doesn't have to always be move-in ready. They'll overlook certain things. They're not as picky. Now, when it comes to an FHA appraisal, an FHA appraisal sticks to the property. It binds to the property for 6 months. So in the previous example, when I was given, I'm going to sell my home for $500,000 during COVID. And one of the reasons FHA buyers were overlooked is because that appraisal was going to stick to the property for 6 months at 475. Now, here's the thing. If I'm trying to sell my home for 500,000, and in that previous scenario, I'm in contract and the appraisal comes back at 475, and let's say the buyer doesn't have the money to make up the difference. So I cancel. Originally, I had the property listed at 450,000. Our contract price was 500,000, but the appraiser said it's worth 475. Now I cancel my listing. I don't cancel my listing. I cancel the purchase with that buyer and I give them their money back. Now I go back on the market and I relist the property and I'm listing it at 475. My dreams of getting 500 kind of got crushed because now the bank is saying, hey, it's only worth 475. So unless there's somebody that really wants my home, when a buyer's agent calls my agent, they're like, hey man, how can your guy expect 500 when he's already been told it's worth 475? Because that appraisal sticks to the property. When it's a conventional loan, it's an independent loan. Nobody knows about the appraisal except for the parties involved. It does not get bound to the property. So let's say I accepted a conventional offer at 500, not an FHA offer, but I accepted a conventional offer at 500. And the bank comes back and says, hey, your property is not worth 500, it's worth 475. I asked the buyer, hey buyer, do you have the money to make up the difference? No, I do not. Okay, then we're just going to cancel our deal and I'm going to go back on the market and I'm going to go back on the market back at 500,000. Nobody knows my home was just evaluated at 475 during COVID. It was a conventional buyer. So that's the differences in markets. Right now that it's a buyer's market, sellers don't care that you're FHA. Sellers don't care that you need assistance. Sellers are going to bend over backwards to make this deal work. This is the time. And back then during COVID, like I mentioned, sellers wanted you to come in with cash above asking and don't even talk to us if you're FHA. You better be conventional or cash. We're not accepting anything less. So that's what made that market so challenging. Really quick on loans, here are some other type of loans. And in the other video course that I'll be making, I'll go into detail with all of these. But there is an FHA loan where I mentioned that homes need to be move-in ready. There is one loan that's called the FHA rehab loan, where you're able to purchase a property that needs rehab repair, but you also need to get quotes on the repairs from a contractor, a licensed contractor. And it used to be that they had a list of contractors. It had to be one of their contractors that they use for the bidding. You don't have to anymore. So, but they do have to be licensed. They do have to be a contractor and they have to be active. So if you happen to know a contractor and they give you a bid saying, hey, we need, $10,000 for a roof, we need $8,000 for flooring, we need this and that, and they submit that, you could get a loan that's going to pay for the property and pay for the rehab. Okay, and that's the FHA rehab loan. Now, when it comes to the cost of buying a property, I mentioned the down payment is going to be around 3.5%. I mentioned that your closing costs to the lender are going to be another about 2%. And the title fees, let's just say about another 1%. And then the agent seller fees is going to be another 2 to 3%. So as a buyer, you don't have to pay the 2 to 3%, even though the law changed where sellers aren't required to pay the buyer's agent fee. They're still doing it. Thankfully, I prefer that the sellers help with that case, because it helps my buyers. Now, let's say you get approved for a loan, and we actually want to go look at homes now. So, what's that like? What's it like viewing homes? So, when going out viewing homes, it's going to be one or two things. It's either going to be an occupied home or a vacant home. So if it's occupied, then we make an appointment. If it's vacant, we can go any time. Um, there's going to be a lockbox with the key that agents have access to. Next thing, in regards to home, a home can be contingent or non-contingent. So when a home seller goes to put their home for sale on the market, it could be, hey, I'll sell my home only if I can find a replacement property. So that means they're contingent on selling their property if and only they can find a replacement property. Sometimes a homeowner can just be, hey man, I already got my place to go, so I just need to sell this home. So I don't have any contingencies. Next. When we're looking at homes, are we able to offer on multiple homes? Yes, you can, because a buyer has multiple ways of getting out of a deal, and deals tend to take a few days to get official and into writing and stuff like that. So let's say we're working together and we're out looking at homes, and we look at 10 homes, and out of those 10 homes, you like 3, and you wanted to offer on all 3. We can. And here's why. When it comes to finding out just how low a seller is willing to go, we're only going to find out if we put that in writing. If I'm not sure what your perception is of real estate, but sometimes people think that we're just going to call and just negotiate the numbers over the phone. I do that. We do pre-negotiate, but a good listing agent is not going to always just give you everything on the first call. Their job is to get their seller the best possible deal, even if they're in an unfavorable market. They still got to try their best. So they're not always going to give you the best deal over the phone. That's going to come in writing. So let's say we go look at 10 homes. Let me write this down so I can keep track of where I'm at. Let's say we look at 10 homes and you offer on 3. Out of those 3 offers, let's say 2 of them get accepted. You can't go into contract on both. You're going to have to choose one. Okay. So let's say we get into contract with one property. So you choose one. You choose one of the homes and we get into contract. What happens next? Can I get out of my deal? So once we get into contract on a property, we're going to have 3 days to put a deposit down. 3 days, and it's typically 1% of the purchase price. So for a home that costs $500,000, you're going to put down $5,000 as your deposit. And we have 3 days to do that via check or a bank wire. Now, let's say we make that deposit, and then you see another home go for sale right down the street, and it's cheaper and it's better, and the seller's already agreed to sell it to us at that price. Let's say I know somehow, I know the agent, and we're able to do this. You're like, Hector, I just put a deposit down in this house. Can I get my deposit back? Yes, you can. Because we haven't even reached steps 3, 4, or 5, which I'm going to talk about. So if for some reason that happened, yes, you could. You would have canceled your deal over here and you would have get you into another one. Those are rare cases. I'm just saying it can be done because that makes me look bad as an agent sometimes. Or anyways. So the next way a buyer can get out of a deal is disclosures. What are disclosures? Real estate is the most litigious profession, and California is the most litigious state. Because of that, our real estate contracts have so many pages. These things are about 100 pages. Why so many pages? the sellers are asked to disclose a lot. So there are questionnaires that a seller must fill out before they sell their home. And it's going to be a lot of the questions. Anything that, what do you know about the home as far as defects, anything you can tell us. I'll give you an example. Let's say you go and you look at a home and you read the reports from the seller, and the home's in tip top shape. I mean, everything's up to code. There's not a single issue with the home physically. But let's say you buy the home and you notice that it was in a nice area and it was close to a school. It was close to the high school, which you liked, because one day your little ones would be in high school. And that's part of what made you buy the home. But let's say you didn't realize this, that football happened to be super popular in this town that you just moved to, and you had never been to this town, and that the football is so popular that the neighborhoods nearby, the streets get full of cars because that's where the people park. So it limits your access, or it creates a noise or something like that. That's something that actually needs to be disclosed by the seller. Either though it's not something from the home, they need to disclose that. Why? Because someone in Southern California sued a homeowner for that and they won. So usually when there's a lawsuit and something new happens, then the lawyers that work for National Association of Realtors will come up with a document to include that into the contract to protect the agents and to protect the brokers. So in those disclosures, if you see something you don't like as a buyer, you have the right to back out and you get your deposit back. Okay. So you have 3 days right to resign in California with your deposit. If you get your disclosures and you don't like them, you can back out. Now we're going to talk about the 3 big ones. So in regards to real estate, if we work together and I help you buy a home, there's going to be over 100 pages that you're going to end up signing throughout this deal. But there's one piece of paper that holds more weight than all those other papers combined. And that's called the contingency removal. Because when this happens, there is no coming back. There's nothing you can do. You have to go through with the purchase, or you can lose your deposit or possibly get sued. So what are contingency removals? I kind of call them like my 3 strikes, like in baseball. So number 1 is an inspection. When you get into contract to buy a property, we're going to give you a list of all the possible inspections someone can do. You can check the boxes of which ones you want done, and then we hire people to get that done. So a typical home inspection is going to be a general home inspection where it's going to tell you what the findings are, but not remedies on how to fix them. And just so that you are aware of the general condition of the home. I have inspectors that I use and I trust, and then that's why I recommend, and it's going to be about $500 for a home inspection. Next, pest is a must do. Pest you want to do all the time because there's no way I can spot termites. So when it comes to the pest, they're going to check the home and they're going to check for termites. And typically, whenever I hire my home inspectors, the home inspector will start inside the home and the pest guy will start underneath the home if there is underneath access, or will start in the roof if there is roof access. And then they switch. And then once they're done, they tell each other, hey, what'd you find? Hey, what'd you find? Hey, I saw that. I saw that too. Hey, I didn't see that. I didn't see that. Okay, let me go back and check. So they double check their work. So that's pretty cool. So you have rights to these inspections. A home inspection is going to cost you about $500. A pest is going to cost you about $200, and a roof inspection is going to cost you about $200. So if you want this done, expect to pay $1,000 out of your pocket. This does not go towards the loan. This is so that you know what you're getting yourself into. If you do not get any of the inspections, you need to sign a paper saying, hey, I did not get inspections, so I'm not going to sue my realtor or his broker if something comes out because I chose not to do this. Okay? You're not going to sue us. I recommend you always get your inspections. Next, appraisals. So let's say we do inspections, Let's say we put on a home, everything looks fine, and it's a home with the pool, but it turns out there's a crack in the pool and it's leaking water. Then we go, we send an inspector, and they do some that. They say, hey, guess what? We can get it fixed, but it's going to cost $5,000. At that point, let's say the seller has the $5,000. He can pay the company $5,000. They get it fixed. Once it's fixed, we reinspect, we get a clearance, and we move on and we remove our inspection contingency, which means I've done all the inspecting I need to do. I'm going to sign this piece of paper that says I'm okay with the inspection, and we can remove this clause from my purchase. Next is the appraisal. We want the appraisal to always come in at value or higher. If it comes in lower, we must, in some cases, we have to renegotiate at minimum one term, which would be the price, maybe other terms. So let's say you offer $500,000 for a home, and the sellers agree to give you 15, but the appraisal comes back instead of 500, it comes back at 485. You might say, "Hey, I'll sell to you at 485, but I can't help you with the 15 anymore. I can't help you with the $15,000 towards closing costs. I can't." Right? So it depends. But let's say the appraisal comes back at value, the value's there, the condition is fine. We sign off on that and we move forward. The very last contingency is the loan. So up until the point that it's almost time to close the loan, within the last week, the lender is going to make sure that you're still employed, and they're going to do a verification of employment. And they're going to make sure that nothing's changed amongst your hours or anything like that. This part is called underwriting. I wish that more banks would do underwriting in the beginning, but they do not. It gets done at the end, and I don't like it. Because that's the department that looks under every rock, that looks under everything they can look under, to make sure that you haven't left anything out or lied about anything throughout this whole process. So when you meet with the lender, what you want to do is be as honest and truthful with the lender. We're not, as real estate professionals, we're not looking to disqualify you. We want to qualify you so that you can get a home and we can make a living. So be honest with us and let us know of your situation. Let me give you an example of when this did not work out, when a client was not fully honest. So I had a military veteran who was married and then got divorced and then changed religions. When he changed religions, this religion that he changed to, he wasn't allowed to have like a divorce or anything like that. So he did not disclose that to his new wife. Now, he did not have any kids with his previous wife, but he was married. And what I did not know is he was employed, and he was also had his own company, but he was paying her through a secret account through his business company. And he never mentioned this on his application because now he was buying a new home along with his new wife. So what happened in underwriting, they're like, "Hey, are you sending $1,000 a month to someone for something? Is this a business expense or what is this?" And then he came clean and said, "Okay, I'm divorced and I've been giving her $1,000 a month, but I didn't think it was a big deal." It was a big deal. Here's why. It messed up his debt to income ratio. So from 40%, he went to 41%. No longer qualified, right? So we want to be honest, because if there's any issues, we want to make sure that we get those taken care of up front. I'll give you another example of where underwriting almost killed a deal for me. I had a client who came from another country, and eventually was able to get resident status here in the United States. He was able to get things worked out, but there was a name change. The name that he used when he originally came over to the name he used when he became a resident, there was a change. He had an eviction on his record from when he first came to the country under his previous name, not his new name, his previous name. And there was on court record in Santa Clara County. He was from San Jose, and he was looking to buy. I was helping him buy in the Central Valley in Lathrop. Well, that came up, and we got like 3 days to close the deal. If not, he's going to lose his deposit and lose the home, because this is during COVID where people weren't given extensions. He had to get a day off of work. He wasn't English speaking. He was Spanish speaking, so this was rough enough. And he had to go to the courthouse in San Jose, Santa Clara, to get this cleared up while the lender, my lender, Veronica, is on the phone with them, walking them through on what he needs to do. And she's never been there, but she's just going based off her experience. It's like, all right, how can I guide this guy to talk to the right people, to ask the right questions to get this cleared up? So that eviction from 20 years ago under a different name almost came up to bite him in the butt. So that's why we ask that you always be honest with us. We're here to help you, not work, against you. But that's kind of how the home buying process works. I gave you guys a little bit overview on me, and I dived into the home buying process. Now, when it comes to the home buying process, one thing I forgot to mention, and it was in my notes, and I completely skipped over it, is the FHA loan limits. And I'm going to include that as a link. So in Stanislaus County, let's look up the FHA loan limits for California real quick. And this is the actual FHA website. So let's look up Stanislaus. So Merced County, you'll see here, the maximum they can lend on an FHA loan is $524. For a duplex, it's $671. For a triplex, it's $811, and for a fourplex, it's $1 million. Let's go over to Stanislaus. What does that mean? If you want to get a home, but down payment assistance, in Merced, the home's going to have to be priced $524 or lower, or else you can't. You'd have to make up the difference in cash. In San Joaquin, it jumps up to $678,000 maximum, which is super high. That's pretty good. And in Stanislaus, the maximum is $535,900. So if you want to buy a home in Stanislaus using the FHA program with down payment assistance, it cannot exceed that price. And let me get this, and I'm going to add this to my little cheat sheet that I'm going to make for you guys. And I think that's it. I think that kind of covers it all. And I want to thank you guys for taking the time to watch this video. I'll be making more. I went an hour, which is an hour and 2 minutes, was just exactly what I wanted to do. No more than an hour. But in 1 hour, you got to know a little bit about me. And I think you got enough information on real estate for like a first-time home buyer. Like you've got plenty to get started. Thank you guys. And call me 510-244-3998. Call me, please. I would love to help you out.